Cash flow is the lifeblood of any business. It's essential to know where it's coming from and where it is going. Hello and welcome back to Exploring Finance with Prashant. I am thrilled to have you here as we continue our exciting journey in the world of financial shenanigans. In the previous episode, we discussed about the techniques that are used to manipulate the operating cash flows and how the excess amount of outflows which the management does not want to be shown in the operating cash flow are transferred to other sections of the statement of cash flow such as the investing cash flow. Now, let's get on with today's episode. In various regions across India, the beloved dance reality show Dance India Dance has taken the nation by storm, establishing itself as one of the most influential television franchises. The premise is elegantly simple. Contestants compete in a series of dance performances. Achieving top scores in each performance can lead to a life changing victory, while falling short in just one routine can mean elimination. When a contestant faces a particularly challenging dance routine, they have access to what we can call as lifelines. For instance, one lifeline allows contestants to receive coaching and guidance from a professional dancer, while the other one permits them to request a second opinion from the judges. These lifelines often prove invaluable, rescuing contestants on the brink of elimination. However, they must be used sparingly, as there are only three available, and once they are used up, they are gone. Similarly, in the context of businesses navigating financial difficulties, companies may rely on essential lifelines to maintain their cash flow. Just as in the dance show, it is often a prudent and entirely legitimate strategy for companies to utilize these lifelines. However, unlike the show, companies may not always disclose their use of these temporary financial aids. It's up to you to identify them because once they are exhausted, there is no turning back. So, in this episode, we delve into four unsustainable tactics that companies use often to employ and to enhance their operating cash flow. Let's take on the first technique, that is paying vendors more slowly than usual. The delay payment strategy can serve as a valuable tool for managing finances, and there is nothing inherently problematic about holding on to your funds for an extra month. Similarly, it's entirely reasonable for a company to negotiate extended payment terms with its suppliers to enjoy immediate cash flow benefits. Nonetheless, it's imperative for individuals and businesses alike to recognize that deferring the payments indefinitely is not a viable long term approach. The financial gains derived from stretching out payments, effectively increasing the accounts payable, should be regarded as a one time event rather than an indication that you have stumbled upon a sustainable means of consistently generating more cash. While this may seem like common sense, it's astonishing how companies highlight their robust cash flow from operations without disclosing their practice of extending vendor payments as a significant contributing factor. After losing a leadership battle at GE, Bob Nardelli became the CEO of Home Depot in December 2000. Initially, he was seen as a savior for the struggling company and managed to double its cash flow from operations to nearly $6 billion in his first year. However, this dramatic CFFO growth was mainly due to a change in how Home Depot managed its relationships with suppliers, notably by delaying payments to them. This change allowed the company to extend accounts payable from 22 days to 34 days by the end of the fiscal 2001. In the following year, Home Depot faced the challenge of sustaining such impressive cash flow from operations growth, which couldn't be replicated because they had already stretched the payables significantly. CFFO fell to $4.8 billion in 2002, While Nardelli's cash management techniques were appropriate, investors should have seen the $3 billion increase in the CFFO in 2001 as a one time event and anticipated the decline in 2002. Another thing to watch is for significant increase in the payables relative to the cost of goods sold, as this may indicate that a company has extended its payment terms to vendors. Recognize that CFFO, cash flow from operations, growth resulting from this practice is likely unsustainable and not tied to improved business performance. Be cautious when companies employ accounts payable financing. In such agreements, a bank pays off the vendor invoices and company reimburses the bank later, effectively replacing the accounts payable with a bank debt on the balance sheet. And now you know that accounts payable and bank debt do not have the same treatment in the cash flow, right? And because the repayment of the bank debt is classified as a financing activity, it conceals the cash paid for inventory as an operating outflow on the statement of cash flows. T-Mobile, for instance, used vendor financing for handset and network equipment purchases in 2015. They repaid 564 million in short-term debt related to these transactions. However, this cash flow was recorded as a financing activity on the T-Mobile's statement of cash flow, making it less visible as an operating outflow. Beyond managing the accounts payables, companies can influence their cash flow by strategically timing the payments on various liability accounts, including taxes, payroll, bonuses, pension plan contributions. These liabilities can significantly impact the cash flow from operations. For instance, the case of Callaway Golf Company in 2005 illustrates this concept. Callaway experienced a substantial increase in the cash flow from operations, soaring to $70.3 million from a mere $8.5 million in the previous year. However, a closer examination unveiled that the bulk of this CFFO growth was attributable to a remarkable shift of $55.8 million in the impact of tax payables and receivables, likely due to net tax refunds and settlements. And this clear tax related swing on the statement of cash flow should have alerted investors that Callaway's remarkable CFFO growth was unlikely to be a recurring trend. So, here are the learnings from this technique. First, the practice of delaying the payments to vendors can be a useful financial management tool for individuals and companies alike. It allows for the temporary retention of funds, providing the short term boost to the cash flow. Second, the example of Bob Nardelli's tenure at the Home Depot illustrates how a significant increase in the CFFO resulted from extended payment terms is not sustainable, and we should be cautious when they see a dramatic rise in the CFFO without a clear connection to the improved business performance. Third, accounts payable is a relatively straightforward account. If you see a discussion of accounts payable that is longer than a couple of sentences, there is probably something wrong that you want to know. For example, account payable financing agreements. Let's move to the second technique, that is collecting money from customers quickly. Tesla Motors, the high-end electric automaker, has placed significant importance on the liquidity and cash flow, which have been critical metrics for both investors and lenders. Despite its funding in 2003, Tesla had never reported a full year of positive free cash flow. Consequently, the company heavily relied on debt financing and equity issuances to sustain its operations. In 2016, Tesla appeared to show signs of improvement in its operating cash outflows, with net outflow totaling 124 million, which is down from $524 million in 2015. And however, The most notable change in the Tesla's cash flow in 2016 was its decision to begin accepting orders and refundable customer deposits for its Model 3 sedan, even though the car was only in the conceptual stage. These customer deposits amounted to $350 million dollars in the additional inflows, constituting 88% of the reported improvement in the outflow in the cash flow for the year. Skeptical investors would have recognized that fundamentally the business continued to consume cash at its historical rate. Tesla's apparent improvement in the cash flow was primarily due to successful marketing campaign that enabled it to effectively borrow from the future periods and accelerate the customer payments to better financial results. Another example is of Chinese telecom equipment manufacturer UT Starcom. It showcased a significant improvement in its cash flow from operations in early 2008, following a challenging 2007 marked by four consecutive quarters of negative cash flow from operations, resulting in total cash burn of $218 million. Dollars. The company suddenly reported a positive cash flow of $97 million in March 2008. However, astute investors would have quickly discerned that this apparent cash flow turnaround was the outcome of particularly aggressive working capital maneuvers. A cursory examination of the balance sheet unveiled a $65 million reduction in the accounts receivable, coupled with a $66 million increase in the accounts payable. Moreover, a more in-depth look at the 10Q filings provided additional insights, including a mention of one of the management decisions discussed in the episode number 10 regarding cash flow practices. Unfortunately, despite the positive $97 million CFFO in the first quarter, UT Starcom went on to report negative operating cash flow for the remainder of 2008. By the end of the year, the company had consumed $55 million in operating cash flow, underscoring the importance of scrutinizing the dramatic improvements in the CFFO to understand their underlying causes and sustainability. So, what are the learnings from this episode? First, while many investors are pleased when management says that it is aggressively managing the working capital, you should take this as a warning sign that recent CFFO growth might be not a sustainable one. Second, in both cases, Tesla Motors and UT Starcom demonstrated apparent improvements in their cash flow from operations. Tesla's improvement was largely attributed to accepting the customer deposits for its Model 3 sedan even before its production, and while UT Starcom's improvement resulted from aggressive working capital adjustments. And these examples emphasize the importance of exercising caution when assessing the CFFO improvements. It's crucial for us to deep digger into underlying causes of these improvements to evaluate their sustainability. Let's move to the third technique, purchasing less inventory. Home Depot employed another tactic to boost its cash flow from operations, which, like its practice of stretching vendor payments, was unsustainable. In addition to delaying payments to vendors, Home Depot reduced its inventory levels by not restocking shelves once goods were sold. Essentially, the company purchased less inventory from vendors compared to previous years. This reduction in inventory had the effect of cosmetically improving the CFFO, much like the extension of payables. The statement of cash flows for the Home Depot in 2000 to 2002 illustrates this inventory swing with an outflow of $1.1 billion in 2000, a much lower outflow of 166 million in 2001. Then a return of higher outflow of $1.6 billion in 2002 as the benefit reversed. To Home Depot's credit, the company was transparent about these practices in its financial disclosures, particularly in the liquidity and capital resources section in its 10K filings. For example, the 2002 10K explained that CFFO growth in 2001 was driven by the extension of payables and a decrease in the average inventory per store. In the following year, Home Depot noted that the increase in the average inventory per store was due to its focus on improving the in stock positions. Silicon Graphics, a technology company, employed a strategy where it purchased inventory right at the beginning of each quarter and then aimed to reduce it significantly by the quarter's end, only to repeat the process for the next quarter. This practice was used to manipulate investors' perception regarding the company's liquidity by showcasing inventory purchases at the start of each quarter and appearing to manage inventory effectively. Silicon Graphics attempted to create the impression of financial stability even while facing the risk of bankruptcy. This tactic highlights the importance of carefully scrutinizing companies' inventory management practices and its financial disclosures to gain a more accurate understanding of its financial health. So, what did we learn from this technique? First, buried in the audit report and financial statements is some extra insight about the drivers of cash flow. It is one of the most important sections of filing, but many investors don't know it exists. To find it, turn to the management discussion and analysis in a section often called Liquidity and Capital Resources. This section is a must read for every company you analyze. Second, Home Depot's strategy for reducing the inventory levels to artificially improve the cash flow from operation was unsustainable. This approach, while providing a short-term boost, could lead to inventory shortages and potential customer dissatisfaction if not managed carefully. Investors should be cautious when they encounter companies employing such techniques. Third, Home Depot's transparency in the financial disclosures, particularly in the 10K filing, is commendable. The company provided clear explanation regarding the factors influencing its cash flow from operations, including the extension of payables and inventory management strategies. This emphasizes the importance of investors thoroughly reviewing the financial disclosures to gain insights into a company's financial health and the reasons behind any significant change. Let's move to the fourth technique, that is, the one time benefits. Between 2004 and 2007, Microsoft paid out billions of dollars to settle the antitrust litigation, with Sun Microsystems being one of the largest beneficiaries and receiving nearly $2 billion from Microsoft in 2004. Sun Microsystems transparently presented this significant one time payment in the statement of operations, categorizing it separately as settlement income. This clear disclosure made it evident to investors that the income from settlement was non-recurring and unrelated to Sun's normal operations, effectively being reported below the line as non-operating income. However, Sun's statement of cash flow was not as explicit. While the $2 billion in the cash received was appropriately recorded as an operating inflow under the indirect method, it was not individually listed on the statement of cash flow. Instead, it was bundled together with net income. Given the substantial nature of the $2 billion settlement, diligent investors who compared the statement of cash flows with the the statement of operation with the statement of cash flow would have promptly recognized that this source of cash flow from operation was unsustainable and not indicative of the company's core operational performance. In 2004, the Sun's CFFO was $2.2 billion, a significant increase from $1 billion in 2003, primarily due to this non-recurring settlement. Here is the key takeaway from this final from this final technique. The key learning from this example is the importance of thorough and critical analysis when evaluating the company's financial statements. Specifically, diligent investors should not rely solely on one section of the financial statements, but should cross-reference information from different sections, such as the statement of operations, statement of cash flows. In the case of Sun Microsystems, the transparent disclosures in the statement of operations contrasted with less explicit presentation in the statement of cash flow, highlighting the need for careful scrutiny to distinguish the sustainable cash flow sources from non recurring ones. And here comes the end of this episode, along with a final takeaway. The ultimate lesson is that comprehensive scrutiny of the financial statements is imperative. Investors must meticulously examine various sections, including the statement of operations and statement of cash flows, to distinguish between the sustainable and one time cash flows. This rigorous analysis is critical for making well informed investment decisions and gaining an accurate grasp of the company's financial health. Thanks for listening to this episode. In the next episode, we will explore the techniques used to manipulate the non standard metrics or the key performance indicators. Until then, keep questioning, keep learning, and keep exploring the captivating world of finance. Thank you. Have a nice day.